Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to another interesting episode of Honest Money. I'm really excited today because we're talking about something that's real for all of us. You know, it's something that impacts us every single day of our lives. So we're talking about the topic of inflation, and I'm really happy to be joined by Odwa Sihlobo, who is co-head of multi-asset at Prescient Investment Investment Management. Odwa, thanks so much for joining us.
Thank you, Warren. It's a pleasure to be here.
So I think when we're talking about inflation, it might sound like jargon to people who don't study economics and the like. So I thought maybe before we get into the how we beat inflation, we should talk about what inflation is.
All right. Yeah. So I think inflation, I can describe it as the general tendency of the cost of the daily things that we use tends to rise. So by this, I mean, if you look at your groceries, okay, so the cost of your bread, like any oil that you use, any of those staples, those tend to rise through time. And in some periods, they tend to rise even more aggressively. This also filters through to things like your medical aid costs, perhaps even school tuition. But really what it does is it's essentially just means that whatever your budget was, you can now afford less of the things on that list as time goes by. And particularly now where inflation or prices of goods have been increasing quite a lot, it's become an even bigger problem, again, given the limited funds that one has to spend on a monthly basis, for example.
Yeah, I must say, you know, if we talk about, let's say cost of living, a lot of the time when we hear about, the Reserve Bank or the Stats SA or somebody out there says CPI has gone up by X percent, and and CPI for economists is trying to kind of get to what our inflation rates are, what your and my personal cost of living increases are. And one of the things that's important to know is that the official measure at a national level is not trying to measure each individual person's cost of living changes. It's a basket of goods and services that they've measured, and they're trying to be consistent to say, well, over time this is how things change. And I don't know if you've had that experience, but when you talk to especially older people, they always say, my cost of living is going up at 10%, and this number of 6 or 7, whatever, is rubbish, and the economists are lying to us, but they're not. They're just trying to get a good average across the entire country and the whole base of South Africans, from very low income, maybe almost subsistence earners, right through to very high income, high net worth individuals.
Correct, Warren. Yes. So the great point you touched on is the impact of inflation is quite specific to individuals, again, on your lifestyle and your life stage as well. So that's why it's really, it is a personal thing. And also, therefore, when you think of ways to mitigate against it, you also need to be currently aware of your financial situation. And again, that's why I linked it to your budget. Like, what's usually in your basket that you need to protect the value of being able to purchase those particular goods, because the representative basket or the country's basket, funny enough, it's an average. So you'll find that probably nobody ever buys that basket, but it's an aggregation of the entire population. And after all, we are quite unique in how we lead our lives. And therefore, inflation is actually a personal thing, way beyond the statistics that we read against. And the dire impacts can be quite different depending on your particular set of costs. So, for example, let's imagine people who spend most of their salaries trying to buy food. Okay, so if then the cost of food, let's call it the staples such as rice or oil, cooking oil and things like that, if that particular basket increases by quite a lot, maybe food inflation is above 10%, right? Even though the national statistic for inflation might be 7% over increases over the last year, you can see that it impacts different people quite differently. And then for other people where medical costs are the ones that eat up a lot of their monthly budget, then that's the main inflation that sort of like again matters to them. So being actually a bit nuanced about what's your inflation is quite important, because again that should lead into how do you even start to think about mitigating against those eroding impacts of higher prices for your basket.
And I think maybe just the other thing is it's to me, inflation is like slow poison. It's not, we don't get a news headline that says to us, gee, watch out, the buying power of your money has just dropped by 10%. So your 1,000 Rand a month that you were spending for 1,000 Rands worth of goods and services is now only going to give you 900 Rands worth of goods and services a year later. So I agree with you 100%. We need to almost track these things for ourselves. We need to know, this is what our typical monthly expenses look like, and then a year later do that exercise again, and to see what that impact is, and then you're much better armed for yourself to make better decisions. The national averages are there and they are valuable, but they're not super helpful for you and me as individuals and where we are in our stages of life.
Correct. Hey, maybe we need a measure called the budget inflation measure, because that will be a bit more specific to every individual. And especially if you do revise or do the budgeting exercise quite frequently, you can keep a quite close pulse as to the escalation of your cost of living.
I keep thinking, the banks have so much data on us, and surely they could actually go through their big data engines and figure this out for us and tell us what it is for us on the ground. But I haven't managed to convince a bank yet to give us data like that. So Odwa, I think maybe let's go on to if my words, if I talk about cost of living as kind of, or inflation as slow poison, then what's the antidote? What's the medicine to help us manage that? I mean, I use the phrase mitigate, and how do we beat inflation? How do we protect ourselves over the next 1, 3, 5, 50 years?
Geez, so Warren, I think on that, I usually like to start off maybe thinking of it in a simpler way, perhaps. So I remember growing up with my mom, who's a teacher, and then whenever she had some savings, I would used to ask her like where she keeps her money. So one of the things that we usually do as individuals when we have excess funds or maybe keeping money for that rainy day, a lot of the time we try to keep that like in a bank account. So sometimes you might have a savings account where you can withdraw the money whenever you want, and that might give you some sort of interest. Some banks, if you have a current account, might not give you interest. All right. So what I just want to highlight is that maybe the first part of actually combating inflation perhaps is to have your savings grow at or a faster pace than inflation. So as I mentioned, one of the usual things that we can think of are our bank accounts, but we know that on a savings account you might not earn a lot of interest, but something that we also do know or are used to are what you'd call notice deposits. So that's where you say to the bank, okay, look, I'm not going to have access to my money for the next week or a month, and then to compensate you for that, they'll pay you slightly higher interest, okay? And then we also have what you'd call fixed deposits, where again you are then putting in money for fixed terms, maybe 1 year or 3 years out. Again, there you get even a higher interest rate. So it's always important to then compare what interest you are making on those savings, as an example, versus the cost of living. Because if you are earning 5% on those, let's call it fixed deposits, I'm just making numbers up here, but the cost of living is going up by, let's call it 7.5%. That means actually you are falling behind by that, whatever that difference is. So therefore, I remember then going back to my mom after learning a bit more about these other investment products. I was like, hang on, mom. Actually, there are other opportunities there that are offered by the investment industry. And they actually have a quite nice appeal in that these unit trusts, right, which provide you with income. But the great thing is you can get your money out like within a day, unlike a bank that usually puts you in this locked in period. So that's the one difference. And what these products actually actively try to do is to pay you a higher interest rates than inflation. Okay, so they might target inflation, let's say plus 2% over any rolling 1 year period, as an example. But the great thing is you always have the flexibility to take your money out whenever you want. So just to paint the spectrum, is it starts off as simple as in a bank account, but in a bank account, again, you don't really get too much inflation protection, but there are quite nice products which are very risk averse that are offered by the investment industry. So some of them might go by names such as income funds. Some of them are called let's call it money market funds. So again, very on the risk conservative side, but that's the starting point, especially on the shorter periods of time, to just do slightly better than inflation, but have access to your money, right? But when we start looking at a longer term now, right, then we can start talking about, okay, maybe I don't want to necessarily take my money out after a year or 3 months or something like that. I'm thinking more longer term. Perhaps I want to invest for kids who just started high school, and I'm thinking about tuition for university. And now I'm trying to think of horizons that I'm actually willing to put my money away and not look at it for the next 5+ years, right? So that's when you can then start looking at taking on slightly more risk. Okay, so that's when you start looking at what you'd call multi-asset funds, or perhaps even equity funds, right? But I'd like to just pause there if there's any question you had in mind, Warren.
No, I think I think it's a good point. So it was a bit of a trick question for you. So I guess when we're looking at growing our money, we need to buy. We do need to buy investments when we're looking at, let's say, 3 years and longer, that we give us a really good chance of beating inflation. Over shorter periods of time, as you say, from 1 day to maybe 3 years, and that's my time frame, but 1 day to 3 years, you're looking for basically the best rate of interest that you can get, and try not to take too much in stock market risk or property market risk, and so a high degree of certainty and as much interest as you can, and what you're trying to do is just match inflation if possible, because I guess one thing we need to talk about there is, if you earn, let's say you're lucky enough, I don't think it exists, but if you're lucky enough to find a money market fund that pays you 10% a year interest, and inflation's at 7%, you feel amazing. But what you must remember is you might be paying away 30% of that, or 3 or 4% out of the 10 just for tax. So we must never forget that tax is a big factor when we're earning interest, and that's why I like the way you're breaking it up now, because short periods of time, great, let's earn interest. We know we're just basically standing still, hopefully, if we're lucky and we've done our homework. We're standing still against inflation. But when we zoom out to 3, 5, 10-year periods, then we're looking at risk, because I think that's the one thing. And then to your point, we're starting to talk about investing in balanced funds, or I know the industry loves this jargon, multi-asset, but for me that just means funds that have a combination of cash, bonds, property, shares, and then it's about how much of those. And I think that's I like where you're going with this.
Correct. Yes. So again, yes, like I think maybe let's touch on equity as an example, and then we go to the balanced offerings that one could look at. So the appeal or the motivation for investing in equities, or what that really means, is you start owning shares in the companies that are listed on the JSE. So what that allows you to do is, if you invest your 100 rands in a basket of those shares, what you then have is you have access to the profit pool that these companies generate, because now you're actually an owner in these companies. So these companies then pay dividends, and again, the better these companies do through innovation and technology and growth, then even the underlying pool of shares increases in value, because again, they are expected to generate even higher profits into the future, right? So again, investing in shares is like investing in the underlying businesses, and these are businesses that we actually interact with every day, from your cell phone networks to your supermarkets and all of that. So the great thing is that those companies actually do pay you nice dividends, and you're participating in the profits. And as you alluded to earlier, the nice thing about participating in company profits is that they are taxed at a much lower rate than what you and I are taxed at. So by receiving dividends, i.e. that is a profit share from the companies, you're paying, let's call it, I think it's about 28% in tax right now, whereas individual people's taxes can go all the way up to like 40%. So you can definitely see the benefit there. So now what you then do in a balanced fund is you actually then also recognize that there's a little bit more risk in investing in companies. As you can imagine, there's a lot of risk in running any business, right? So I always say, think of it like that. If you own shares, you're a business owner. And as you can imagine, there are a lot of turmoil, a lot of interesting things that can happen during that period. So to try to reduce that risk, we say, let's not put all of our 100 rands in equities. Let's put some of it in bonds. So we're lending to, say, the South African government, and actually we even lend to other foreign governments, let's say the US or the UK or Japan. So just diversifying where we're going to be making our money from. And also we can invest in income generating assets, as I mentioned, like your cash type of assets. But what we're getting at here is we started off by talking about something that's very very low risk. So we wanted to protect our capital. Then, so that's talking about the money market and the income funds and the bank accounts. Then on the other spectrum, we just spoke about equities. So basically investing in businesses, that's like very higher risk. So what we're trying to do in a balanced fund is then marry the two so that we are somewhere in the middle. We get higher returns than we would get from our very low risk assets, right? So that means we can do better than inflation, but we don't want to be surprised when there are big shocks in the equity market. So that's what the balance fund does. And then as asset managers, we really spend our time making sure that we combine those in the best possible way to combat inflation, so that we can deliver inflation beating returns over horizons of 3, 5 and more years. All right. And that's really the key here. And again, the time horizons also, as I mentioned, are slightly longer for your balance funds than they are for your very lower risk type of propositions.
So I think important to understand as an investor, when you're buying something that's going to give you a good chance of beating inflation. I mean, to your point, Odwa, that that comes with the risk that you start on day one and you've got 1,000 rand in there, but stock markets fall apart and bond markets have a tough time, and suddenly your 1,000 rand's worth 800 rand. That's normal. That's part and parcel of the tide of markets. Tides come in, tides go out, and that's what happens. And it's okay. That's not a problem unless you panic and you sell out at after month 3 because you think it's never going to get back together. And I think to your point, Odwa, I like that, is that when we're investing, we want to beat inflation, we want to grow our money, and therefore this risk of going up and down, the jargon for that is volatility. Just understand it's kind of like a season. Seasons come and seasons go. Stay invested, and over time you give yourself the best chance of growth. From my perspective, looking at this, it's always about buying growth assets, and growth assets are most of the time are going to be shares in companies, government bonds when they're in good, well managed governments, hopefully, and then property companies might be part of that conversation as well. The best growth will usually come from shares as an asset class, but understanding that comes with the biggest roller coaster ride. So the marriage of managing some risk and taking some of the risk off the table and getting as much growth as possible is where we get to balanced funds. So they're not perfect. It's not a guarantee that you invest in a balanced fund and you never see it go down. It certainly will go down from time to time. Hopefully not as much as the stock market, but what you're aiming for is to get as much growth as possible, nearly as much as the stock market, without the risk of the biggest losses that you would see in markets. I think that's a fair summary.
Correct. Yes. And you mentioned a great point there in terms of like sometimes psychologically. When things go down, as an example, we might tend to panic, right? And when things go well, we love that. But it's always interesting that we treat bad events differently from good events. So it's always wise for one to actually guard against that and actually understand that it is actually normal to feel worried that things have gone down. But at the same time, you need to guard against then having a knee-jerk reaction to it. It's easier said than done, but that's the key. Again, going towards staying invested, because that's really what really matters at the end of the day. So what that means is, as long as you have the mix of your growth assets correct, okay, in the long run, as you mentioned, Warren, you're going to actually do quite well, right? Because the other nice thing is that they dovetail with one another. Maybe equities are not having such a great time, but you have your bonds that are generating this income because they pay interest quite regularly, right? So then that offsets some of that, but in the long run, it all builds up. It all builds up on top of each other. That it does go up. So the key is to remain invested, and also just to make sure that as long as that portfolio is in a safe pair of hands and it's allocated quite properly, you shouldn't try to override those rules, because it's quite hard to justify sometimes. It's like it's like, how can I put it? Okay, I'm rambling now, so I think I'll just leave that one aside.
So if we had a song for this particular episode, it would be called "Don't Worry, Be Happy." And I think that's the point. Once you've got your strategy right, just sit back and let the strategy unfold. Odwa, we're running out of time, and I've got I always ask new guests to our show my favorite question. And so it is, if you had to meet your let's say your 21-year-old self now, having learnt the life lessons you've learnt so far, what would be the one thing you would like to teach your 21-year-old self?
Start saving now. Every little amount counts. It's amazing, like how little it actually takes to start saving. So whatever money I had, maybe because I used to tutor as well, I could have actually be saving it rather than just keeping it in a bank account. I could have been investing it, and then this power of compounding again would have just helped out through time, and would have seen that come through. So it's almost like it's just that discipline of whatever small amount it is. It actually doesn't take a lot of money to start investing. So that was the key thing. I never thought I could invest. I thought I needed big amounts, but you don't, because sometimes you can do simple debit orders of 500 rands a month, maybe a lump sum of 1,000, and maybe when you come across another 1,000 at another point in time, you do that. And when I did that simple calculation of how much I would have made, I was like, geez, that's a nice sum. Also, just from modest putting stuff away. So having that discipline, and then just making it a rule, it carries, it compounds quite a lot. That's the power of time.
So now we've got two. So it's just get started and don't worry, be happy. I think that's a summary for our show. Odwa Sihlobo from Prescient Investment Management. Thanks so much. It's been fantastic to have you on the show. I think you've shared some wonderful information with our listeners, and I hope to chat to you again in the future.
Thank you, Warren, and all the best to all the listeners out there. Cheers.
Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.